All right, guys, so here's a chart displaying price to book value ratio on the stock market. As of now, it's the highest it's ever been. The average in the S&P 500 is 5x. I've been telling you this. The last time that happened was the dot-com bubble, and certainly you were in a bubble and it crashed. What people need to know about book value and what it really is, it's your assets minus your liabilities, whatever's left. That means it's shareholder equity. It's called book value. And a company trades off a multiple. They might give you 5x, 10x, 20x. In some cases, I even see 100x. You see people trading at tremendous values right now. Valuations are extended because people are growing their business off of debt. And this is the problem. So if you guys want to know the real problem, what's going to happen with this market, this is why Trump's asking for lower interest rates from the Fed. It's because the Fed rate is so high right now that all that borrowed money is due. And that borrowed money is just valuation. It's Wall Street giving you value for money that you've deployed over the years. For about 15 years, from way down here at the bottom in '09, the housing crisis, all the way to now, right after COVID, and they printed $6 trillion and they gave it out as stimulus, all that money, the $6 trillion they printed, the Fed themselves, they went ahead and gave it to all the people. The people have circulated those funds throughout the economy over the last 3.5 years, and that money has trickled all the way to the top. And as it's trickled to the top, well, those guys don't spend money. They're not out spending like we were during COVID. Those guys actually put it back into the markets. So what do you see? You see companies getting valuations, and you see an increase in the Mag 7, the top 7 stocks. It might even be something like Nvidia at $4.5 trillion, and or Microsoft at another $4 trillion. Companies are getting trillions and trillions of dollars, those $6 trillion to be exact, all at the top of the market right now. So that's what's pumping it. That's the valuation. But what happens when you don't adjust rates? Pay attention. Go back. If you don't adjust rates, all that borrowed money over the last 4 years that you were a growth company, you're a mega capper, you're just trying to go up and to the right, you have to pay. Banks can't negotiate. They have to renegotiate. And as of now, on the 10-year, you have to renegotiate those rates, and you can't because the values are too high. This is why you need a lower interest. But here's the problem with lowering interest, okay? Just to finish this off full circle. If you lower the interest rates 150 basis points, 1.5 is what they're looking for. Well, now you have to take into consideration inflation, CPI, and PPI. All of it is actually going to be more than the ratio that they give you. Meaning if the Fed rate jumps below 3.5, 3.2, well, now inflation is outpacing the Fed rate. And you can't do that because then you're in a cycle, and it's called stagflation. Meaning there is no growth. All the money you're growing as an economy is just paying for the inflation in front of you, i.e. tariffs. You have tariffs that you have to pay for. Either the consumer is going to pay for them or the distributors are going to pay for them. And right now, we haven't paid for them yet. You'll see what I'm talking about real soon. That market getting ready to tip and fall? Oh, what do you know? Hey, you know what's even better than that, though? Pay attention. If you invest your money into companies that are not in the S&P 500, not in this whole charade, then maybe you might win. Go look at the S&P 400 and see how they're not getting valuations that are at least 5x on book. Nope. You know who they are. I know who they are. GameStop? Can't stop, won't stop. GameStop. That's all I buy. Peace.